Welcome to Money Thoughts, the financial educational program that helps you think about, better understand, and have more power over your money. Today's Money Thoughts program is sponsored by Loan Depot. I'm Deborah Frazier, and I am very excited to be co-hosting the show today with my colleague, Peter Crowley. And to give you a little more information about myself, I am a wealth management advisor with LRG Wealth Advisors. That's the name of my team, and we're located at the firm of Hightower. I've been in the financial services industry for more than 35 years, and I specialize in providing investments, retirement, longevity, and estate planning services to corporate executives, small business owners, and wealthy individuals. Now, Peter, would you like to introduce yourself and to introduce our special guest for the day?
I sure will. Thank you all for tuning into Money Thoughts. This is our inaugural program, and we're thrilled to have Tom Gates with us. I'm the vice chair of Central New Jersey Network, CNJN, and Money Thoughts is just one of the many shows we're bringing forward. But I'm excited. I've had a friendship with Tom now for well over 15 years, and Tom Gates is an expert in mortgages. Tom, you want to introduce yourself?
Well, let's hope. Thanks so much for having me, guys. I'm really happy to be here. I'm with Loan Depot, and I have been doing residential mortgages, not commercial, for going on 30 years, which I shudder to think about. But
I was going to say, yeah.
Just
started when you were 12, right?
Exactly, 13. It's been a remarkable career. It's been incredibly rewarding. It's been a lot of fun. Goodness, it's been challenging with various economic cycles and housing booms and busts, and of course litigation at the highest levels as they tried to figure out the mortgage crisis 12, 14 years ago.
Yeah.
So it's been a great run, and I've enjoyed working primarily here in Mercer County for this whole time.
Well, today we're going to learn a lot about mortgages, about rates and how that impacts it. But my first question, which is on our mind, is the Fed has already said they've raised 25 basis points to the Fed rate. They've said it's going to be another 6 or 7 rate hikes. They're not sure what the amount's going to be, but that has a clear impact on housing. Are 5% rates here to stay, or do you think this is just a temporary fix?
I would say they're probably going to be here to stay. I have lived through, in these 30 years, I've lived through lots of different cycles, as I said, and at the beginning, shortly after the beginning of my career, we were seeing rates in the 9% range. Mm-hmm. And while it was not probably where people wanted to be, guess what? People still bought houses. People still lived their lives. People still made changes with relocations, and they still, believe it or not, refinanced these mortgages. So we rode the coaster downwards from 9 to 8 to 7 to 6. And I think at some point we got to 6 and people thought, my goodness, we're never going lower than this. I mean, we're just not. And history would say that we probably wouldn't, but yet we did. And so I think what we've enjoyed these last many years, frankly, with rates in the 3s, in some cases even in the 2s, really became sort of unreal, surreal. And unfortunately for a lot of millennials and the younger folks that either haven't had a mortgage or they've had a mortgage at these historically low levels, they don't really understand that 5% isn't a bad rate. There's really nothing wrong with it. But yeah, I do think it's here to stay. I think we're fighting inflation, and the Fed is doing their job to try to counter that with increasing rates at the Fed level. So we're seeing rates going up. If the Fed eventually, lassos this problem, maybe we will start to see some rate retreats again.
So, Tom, I like that you mentioned the millennials. It's kind of like a gift, though. Each generation gets to have all of these surprises that the older generation already has been through. They know what's going to happen, but it's like a surprise for the millennials. So they'll get to live their lifetime and see how rates can change. But as rates spiral up, what are you telling your first-time home buyers? Are you telling them to buy a house now? Or are you telling them to wait and buy a house later? Or what are you telling them to rent? Yeah.
Well, I have these conversations every day, and I think long and hard about what I'm going to advise people, because I don't know what rates are going to do. I'm pretty sure you don't know what rates are going to do. And it's hard to advise with anything other than, well, here's what we've been through. And where we're likely to go is hard to say, except, as we just discussed, I don't see rates going back to 2 and 3 and in those levels. So what I'm telling people is, and not specific to millennials, but what I'm telling people is, if now's the time for you and for your family and for your job situation and your either commute or perhaps telecommute, if the time is right for you to change where you sleep at night, do it. And if it turns out that rates do come down next year, 2 years, 5 years, we refinance your loan. So that's my advice. Trying to thread the needle and time it just right, particularly in an increasing value economy that we're in right now with housing values, trying to thread the needle with values and rates is a bad move.
Kind of sounds like time in the market, right?
It does. and I got a question. I know a lot of first-time home buyers hear about their escrow account. They're not sure what it is. Can you explain what an escrow account is and why it's important to a first-time home buyer?
Yeah, it's really not a big deal. I put it in the context of closing costs. If you're buying a house, people talk about closing costs and they get overwhelmed by the number. They think, oh my gosh, $10,000 for closing costs. Well, keep in mind, and these are all rough numbers, folks, half of that might be closing costs, okay? Money that you're throwing out the window. That's it. It's gone. And that's just the cost of doing business to get into a home.
Right.
Third parties have to be paid. Title insurance needs to be purchased. Attorneys need to be paid, etc. But the other tranche of those closing costs are less closing costs and more support for your property on a go-forward basis. So escrows are your dollars still as the homeowner. You're just putting them with the bank. You're putting them with the lending institution so that the lender can manage the payment of the things that are super, super important to them, right?
Such as?
Well, first they want their principal and interest. So you're going to pay them for the loan itself and your process of repaying the note. But the other two components are insurance, because if that house burns down and the bank doesn't know that there's insurance on it, guess what? They could foreclose on a property that's worthless or worth maybe the dirt that it's sitting on. And the other is taxes. And while our mortgages get recorded at the courthouse and we have a lien and we have the ability to take that home from you, the taxing authority, whatever town you're in or state you're in where you're paying your taxes, can jump into first position. Ahead of the bank. So in a foreclosure situation, the bank wants to ensure that those taxes are being paid. Thus, the escrow account. So if your taxes are $12,000 a year, you're ponying up $1,000 a month into your account so that when the tax bill comes due, quarterly, semi-annually, whatever it may be, the bank then makes that disbursement.
What surprised my kids when I had that was the escrow can go up.
It sure
and you
can.
have to plan for that. Don't you think that's a set number? That can go up every single year, that escrow account.
And don't call your lender and yell at them because it's not their fault. They're just doing their job.
Yeah, just tell them they have to pay close attention when you explained it to them at the beginning. So I asked you about first-time home buyers. So what about existing home buyers who want to upgrade to a new home? Is it a good time for them to upgrade to a new home? Or again, should they wait and see if rates come down?
I'm not sure my answer would be a lot different, Deb, for that one, because while the younger, let's say millennial folks are all excited about their new home, it's going to be hard for them to thread that needle. And maybe if you're already a homeowner, it might be even harder to thread the needle particularly if you're in a circumstance where you can't afford to pay the mortgage on your current house as well as your new house. So this maybe is more of a real estate chat than a mortgage chat, but imagine if you were making an offer on a home and you said to your realtor, who said to the seller, hey, Deb would like to make an offer to buy your house, and she's offering, X amount of dollars, which is a very attractive price, let's say. But Deb needs to sell her house before she can close. Well, in this environment where the seller is in the driver's seat, those offers are not getting looked at. They're just not, because there's 5 other Debs that are, maybe paying cash, certainly don't have a home to sell. So it's pretty tough to navigate that, unless you're, among the fortunate that could actually afford to take on the new house while still carrying their current house.
So we all had experience with that in 2008, 9, 10. People were doing that, and then they were getting caught. They were selling one home and then not in, and they ended up. Then they didn't get into the second home quick enough, and they ended up. Well, let me put it this way: they didn't sell their home, but they bought a new home, and then they were playing musical chairs. We all got caught. So now they're paying the mortgage on the new home, mortgage on the old home. So the game can only go on for so long. But today it seems a little different because it seems that people are, one, putting their house up for sale and it's selling so quickly, but they're moving into a new house that they aren't trying to flip. They're trying to buy another place to stay. So, but I know especially in Florida, the prices are just skyrocketing.
Everywhere.
So, yeah.
Yeah. So I think there was a question in there.
I think it was really more of an observation that we've kind of gone through this before, but it's a little different.
Well, it's a little different primarily in that our industry has become, for better or for worse, more regulated. The controls in place, the regulatory and compliance environment is such that you really can't lend money or say yes to someone unless they are qualified. And so years ago with the
that's the big difference.
Less than fully documented mortgages, whether it was income assets or even appraised value or credit, it was pretty lax. And so those days are gone. So most people that get the proverbial loan approval are people that can afford to make that payment.
Okay. We're going to take a short break for a minute, Peter.
Okay.
We're going to look at a short video, and when we come back, Tom, Peter has some great questions that he wants to
delve
ask
into
you.
credit scores and for a young couple, what that means.
Right.
Great.
So we'll take
Thank
a
you.
break. This is Money Thoughts.
The home smells like citrus.
Our home smells a lot like fresh cut flowers.
It smells like cooking.
Which is good.
It's a big, old kind of creepy house from the 1800s.
There's noises everywhere.
The whole thing creaks.
It's 3 floors.
It has a basement, and then that basement has its own basement.
It's like a triple backyard.
There's history behind the walls.
Home is where the heart is. I know it's corny.
Yeah, that is corny. Keep going.
It's just that feeling of coming in and you're like, I'm home.
To me, home means being able to be yourself.
You can walk around in your underwear and no one will see you, except for the rest of your family.
Pets are family too.
I'd rather be home than anywhere else. So, to me, home is everything.
I would have to agree with you.
Okay, welcome back to Money Thoughts. Tom, as we go into the second half of the show, credit scores. You always hear how important credit scores are. Well, I'm a young individual, maybe recently wants to buy a house, worked for a couple of years out of college. How does that credit score affect the rate I'm going to get? And as that first-time home buyer, what should I expect from the paperwork and the frustrations I'm going to run through?
Well, first of all, Peter, I'm sorry that you're young, but you are young and you need to pay your bills on time. So if your credit card comes due and there's a payment due on the 12th of every month, make sure you pay it. That's the most important advice I can give anybody.
Because that is
that's
recorded
listening.
and kept in the credit
You've got
scores.
to pay your bills on time. And that includes not only the bills that are reported, like credit cards, like in some instances utility bills, but the other bills that aren't recorded, right? Your rental payment, if you're living in your parents' guest house or in a wherever you're paying rent, that information is crucial for mortgage qualification down the road. So don't be careless with any of your.
Will that
monthly
stop an
bills.
application from going forward?
It sure can. Oh yeah. So let's say, to answer your question about credit scores, they're super important. The higher the score, the better the rate of interest you're likely to be offered.
That is true. You can get a better rate of interest with a higher credit score.
Absolutely.
Okay.
And it also is it varies by loan to value. So the less you put down, and the lower your credit score, the higher your rate. So if you could put down, 10, 15, 20%, and you have a fabulous credit score, you're going to do really well on your rate quote on a given day. Somebody else with parameters that are opposite from that could get a rate that's 0.25% worse, 3/8, maybe even 0.5% worse.
So what's the amount today that's required to be put down to get a good rate? Say you get a good credit score. What would the amount be? Is it 10%? Is it 20%? I know at times you can go below 10. They used to do that.
Yeah, sure. Well, right now for first-time buyer programs, as long as you don't exceed a certain threshold for income, you could put down as little as 3%, and that's with a Fannie and Freddie program. FHA is and always has been 3.5% down. So if you've got really strong credit and you're putting down as little as 3%, you can still get a fabulous interest rate.
Right.
So that it doesn't really hurt you by being at the higher end of the loan to value scale, because look, first time buyers don't have a lot of money quite often. So it's a tool to help people get into their homes. You asked about, could it be a hard stop? I want to go back to that.
Yep.
If we run a credit report on a borrower and their score is great, and we're discussing, rates and qualifications, and then we, later in the process get to the point where we're sending a verification of rent form to your landlord to verify that you've been making your housing payment on time. Because what's more important when analyzing someone's credit than their housing payment? It's probably their biggest monthly nut. If that landlord writes back and says, "Oh, gee, Peter was late 4 times in the last 12 months," that'll kill it.
Wow.
It can make a big difference.
So, Tom, what other home ownership costs should a new buyer expect to have? They know they're going to have their mortgage, and escrow is already taking care of their insurance and taxes. Are there any other expenses that are going to come up?
I'll jump in. You got to buy a lawnmower and a rake. That's the first thing you got to do. If not, you're in trouble.
Well, if you want to keep your neighbors happy,
Yeah,
that's
really.
true.
You can always borrow your neighbor's lawnmower and have all kind of jokes made about that.
I feel like I should kick that question right back to you guys. I'm sure you've owned homes in your careers. Gosh, I mean, yes, the check that you write or the automatic draft that you have for your mortgage will cover the big ones, the taxes, the mortgage payment, the insurance. But yeah, every utility you can think of, you need to prepare for that rainy day when the furnace goes boom, and you need to spend $5, $6, $10, $20,000 to replace your furnace. If you need a new roof, that's not a small number. For those of us that live in Hopewell Township, we are always scared of the day when the septic system's going to go, because that's always a big expense.
It's true. You come home and you see your neighbor's lawn all torn up, and you go, "Oh no, is it on this block now?"
Please don't let me be next. That's all I ask.
That's right.
Yeah, those are the things that come to mind, certainly for housing. When you're qualifying for a mortgage, though, we are going to look at everything in your monthly debt structure. So we're going to factor in to whether or not you're qualified things like your car payments, your credit card payments. So if you have a balance of $5,000 and your minimum payment, let's say, is $50, we're going to use $50 in the calculation. Student loans, big one these days. Particularly in the last couple years with COVID, there's been a certain amount of forbearance. The student lenders have been very flexible, maybe under the thumb of the government, but they've been flexible, and a lot of people chose to not make student loan payments. So we're getting these credit reports that show, in some cases, hundreds of thousands of dollars worth of debt with a zero payment next to it. Well, that forbearance is nice, but we have to extrapolate what that payment would be and build that into qualifying.
That's a whole nother topic. I have so many questions I could ask
Student
you right
loans.
now about student loans. So that's one of our next shows.
It will be. So, Tom, there's always the idea of there's a ratio. If you have an income, what percentage of that income should go to your debt, we'll call it, which is housing primarily for a young person? And do you stick by that? So what is that debt? So if I'm a young person buying my first house, I can say, gee, I make X. Here's the percentage I can afford. What number is that looking at from a mortgage point of view?
Well, I want you to stop me if I go on too long, because this is a long one. But it used to be that the ratios were 28 and 36, I think.
So 28% of my income went to my debt. Over that, they would have a challenge in lending me more money.
Correct.
Okay.
Those numbers are out the window.
Oh, okay.
Completely out the window. There are ceilings. But we look, first of all, just to take it back, we look at gross monthly income. So if your salary is X, pre-tax, whatever that gross number is, we take that number and divide it by 12 to arrive at your monthly income.
Okay.
We then look at the housing payment, which is principal, interest, tax, insurance. And if you live in a condo or a townhome, you might have an association fee.
Right.
So we look at all of that, and we add it up, and we look at that number as a percentage of that gross income. So that number used to be 28%. Now we see 35, 40%, even over 40%. The other number we have to be very concerned about is the overall debt as a percentage of that income. So your car payments, your student loans, your credit cards, we look at all of that relative to your income. And in the world of Fannie and Freddie, Fannie Mae and Freddie Mac, that number can go as high as 50%.
And Fannie Mae and Freddie Mac are, so our reviewers can hear, they're government-sponsored lending organizations, I believe.
Correct.
Okay.
Correct. And so you can go as high as 50%. Now, we can't go as high as 50% if your credit's a problem. But assuming you're a strong borrower, you could go as high as 49.99% and still get a loan approval. And the conversation that I really like to have with my clients in those circumstances is, now, Deb, we can get you approved for this, but are you comfortable with the payment? And then depending on your answer, I may say something that may be obnoxious, I don't know, but it resonates with people. And I'll say, if you were my sister, or if you were my daughter, I'd not be very comfortable with that. So as your lender, I'm telling you that yes, we can get you approved, but do you really want to be there? Do you really want to be that stretched? And most times people really appreciate that and they think about it.
That has to be a tough conversation.
It is.
Yeah.
It is, because people usually want to, they want to go in and qualify for as much as they can possibly get.
Right.
And instead of buying a $300,000 condo, they want to buy a $500,000 house. But you have to really,
You have to remind them, and if you max out on your pre-qualification and there's a bidding war, you have no room to negotiate, and you're already kind of out. And then you have to remind them of those other costs that they're going to have. So we're coming up on 3 minutes. I mean, this is going so quickly, and I love this conversation that we're having. I want to leave time, Tom, for you to tell viewers how they can get in contact with you. So my final question to you has to do with floating rates and fixed rates. So do you advise first-time home buyers that are moving, that want to buy a bigger house? Do you advise them to lock in a fixed rate, or do you have a discussion with them on a floating rate or adjustable rate?
Yeah.
And in that question, is it easier to afford a floating rate, or does it make a difference?
I'm glad you asked that. It makes no difference.
It doesn't.
Because if you, for those of you that may not be aware, a floating rate is another word for an adjustable rate. So while it still may be a 30-year term, the rate is fixed for a shorter period of time, say 5 years, maybe 7 years, maybe 10 years. And then after that period, the rate can adjust based on current market conditions. So if a 30-year mortgage is at 5%, and you can get, say, a 7-year floater at 4%, you can save a bunch of money over a period of time. But the problem is that can go boom later and get expensive and maybe even kick you out of the house. So when we're underwriting an adjustable rate mortgage, we actually look at the worst case scenario. So it's not like you can take advantage of that lower rate to qualify for more mortgage. You still need to qualify as if you're taking out a fixed 30-year loan.
I did not know that. Okay.
Yeah.
If I'm so sorry, I'm just going to have to cut him off for a second because we're going to run out of time. I'd like for you to let our listeners know, how can they get in contact with you, Tom?
I guess the easiest way is through my website, because there's too many numbers with my phone, but everything's on the website. So it's loandepot.com/T like Tom, Gates, like Bill Gates. So okay. loandepot.com/T Gates.
So Tom, you also, I read that you have also brought in your son has joined your business. Tell us a little about that and what's that like for you?
Well, if I'm beaming, it's because I'm beaming. He joined me about 1.5 years ago, and he actually lives in Bend, Oregon, which might seem insane, but with Microsoft Teams, with the click of a mouse, he's at the desk right next to me. And I never thought that he would get into the business, but he started asking questions when he got to be about 30, and he was used to working for other people. And after a lot of conversation, he decided to take the plunge. So if you decide to work with me, and I hope you do, you're going to get 2 of us for the price of 1. And we really enjoy tag teaming and working with each other to make every client really delighted.
Well, we have really enjoyed having you here as our guest today, our first guest, so we'll always remember you, Tom. Thank you for coming.
This show is going places.
So this is Deborah Frazier and Peter Crawley signing off from Money Thoughts, the show that helps you think about, better understand, and have more power over your money. And thanks again to Loan Depot for sponsoring our first show of Money Thoughts. Thank you, Tom.
Thank you, Deb. Thank you,
Tom.
Peter.
Great. Thank you.